Hi everyone. Thank you for joining us today. My name is Yashin from Syfe's advisory team, and I will be the moderator for today's session. Joining us today is our head of investment advisory, Ritesh, as well as Don, who is also otherwise known as the Budget Babe. And together they will be sharing with us, their market insights for the year and how you can then put your bonus to good use. So feel free to post your questions in the Q&A box below along the way, and we'll be taking some pauses during the presentation to address them. So without further ado, let's get it started. And over to you, Don.
Thanks, Yashin. Hi, everyone. For those of you who don't know me, I'm Dawn. Or you guys might know me online as the Budget Babe. Thanks for tuning in on a weekday night. I hope you guys had your dinner. So the title of today's webinar is how to invest your bonus. But hold on, sorry, I think I need mods. I need permission to switch to my slides. Thank you. Okay, so anyway, the title of today's webinar is how to invest your bonus. But I know some of you guys reach out to me to say that you are in jobs that didn't give any bonuses or had a very little bonus because of the situation last year. So don't worry. It is not what you're gonna hear today is not only about bonus related. It's also going to be, like basically any surplus cash that you have. Okay, so let's get started. Basically, I think some of you might have already known this. I talk about it a lot, but in life, right, we need to distinguish between linear income as well as passive income. And the ideal, of course, like all of us want to have passive income, right? Just sit back on your couch, Netflix, and relax and have money come in without having to worry about the bills. But the thing is that in order for that to happen, you cannot just Netflix and chill now. So it's kind of like delayed gratification. You need to actively start building your different income sources so that you can then have your passive income come in and sustain it for the years moving ahead. Okay, so no one's gonna just hand you passive income on a platter. You need to start managing and building that right now. So for the majority of us, we're probably in the employees quadrant, the E quadrant. Anyway, for those of you who don't know, this is popularized by Robert Kiyosaki, okay, author of Rich Dad Poor Dad. So when we are an employee, we're actually trading our time for money, our 9 to 5 or 9 to 6, okay, for our bosses in order to get a salary in return. And because of this, right, we don't actually have a leverage. If you work overtime, yes, some industries or jobs pay you more, but there's only a limit to how much time you have. Even if you go without sleep, right, there's just 24 hours a day. What more can you do to scale up? You can't, okay? So on the other hand, if you're self-employed, okay, you're still on the blue side and left side of the screen, right? Now you own a job. Let's say you're a tutor or you're a piano teacher or you're an insurance agent. Hey, this time you own the job. If you work, you get money. You don't work, you don't get money. Your time gets you more money in that sense because you can have full control. You may or may not have more margins in that sense, but you also are in the same situation as the employee where you don't have any leverage. You only have 24 hours a day. How many insurance clients can you serve? How many students can you teach? Okay, so that's why what we want to do is move into the green portion. And I think the beauty of last year is that we've seen with e-commerce writing, a lot of people have actually started their own small business. I think that's great. And as a business owner, whether it's a small, medium, or large business, right, what you're basically building is that you now own a system. And when you scale and grow big enough, you can actually hire people to work for you. Maybe in the beginning, when you're starting out, you're hiring people from like Fiverr or Upwork to do like, cheaper cost work for you. But eventually, if you really grow big, you can actually start hiring people in person or have an office in Singapore, so on and so forth. And basically, you're then buying other people's time. Can you see it? Right. So now you're the boss, you're the business owner, and you buy someone else's time. So you now start to have more leverage. Okay. And of course, not all of us might be cut up for business. Like some of us don't really like to be entrepreneurs, or we might not like the whole administrative and legal stuff that has to be done when you own a business. So in that sense, another great way to be is an investor. So as an investor, you can actually use your money to work for you. So you use money to grow even more money. And it's also passive income, just like the business owner, but in a completely different sense, right? So instead of leveraging on people for money, you're leveraging on money for money. But in order for that to happen, you do need to have knowledge and skills and emotional competencies, managing your portfolio, so on and so forth. Okay, so today I want all of you guys to think about it, because we're at the beginning of the year. I want you to think and ask yourself, what combination do you want to be? Now, some people might say, oh, I only just want to be one. I just want to be a business owner. That's fine, but every business owner also benefits from being an investor. So do you want to be like a E plus B and basically have very little leverage in terms of time? Or do you want to be like E plus I? Okay, which is very, very sustainable, and it doesn't require you to spend like hours every single day looking at the market. Okay, you can actually go for your 9-to-5 job and still be able to invest outside of that. Okay, and then or do you want to be like a S plus I? So think about it for a minute, and if you want, you're into New Year resolutions, you can write it down somewhere, and then make sure you start building the second quadrant that you aren't already in. Or if you're in but you haven't done too much, let's say you're an employee and starting on your investment, make sure you start really actively building that I quadrant for yourself. Because when you build on the passive income side, okay, that will actually pay you really good dividends and rewards over time. All right, so I hope you guys understand the difference. Now, I know with the recent bloodbath in the stock markets and even in crypto, actually, everyone's very confused. What exactly are we supposed to do? What's happening? So here's my attempt to try and explain why things are happening the way they are. So if you guys have been following the news, you would have noticed that ever since the pandemic hit, the US central bank, the Fed, has been just, printing money non-stop. Okay, and it's a little bit crazy because they have essentially printed 4.5 trillion, or everything that they've printed in the past, in just 1.5 years. It's like the biggest inflationary supply economics at scale. And it is really the largest history that we've ever seen in modern history. So if anyone tells you that they know how to invest, for sure, with 100% certainty, they're just bluffing. Because the thing is that this has never happened before. And you can look at history, we can study periods of like inflation, stagflation, deflation, and all of that to try and make a sense of it. But what we need to understand is that we are dealing with very new variables right now. So what we can do is try to get grabs on the situation and then play our cards accordingly. But you don't want to fall into the trap of like setting your strategy based on history and then not adjusting it accordingly. Because I think while everyone knew that the Fed was printing money, like how many of you actually expected them to print this much in 1.5? I have to say that took me by surprise as well. Like I was expecting them to print a lot, but this is way more than I had expected. And I guess like no one also expected COVID to last for so long. There were all these estimates saying that it'll be over in a year or two, but we're nowhere near. And as of yesterday, our government has just also announced that Chinese New Year regulations will still follow the current COVID scenario. So it looks like Chinese New Year family and relatives house hopping and visiting are out of the question. Right. So what's the result of this? So COVID reliefs cost a lot of money. In fact, what I was very surprised to see was that the total amount that the government spent is actually more than all of our humanities war since 2001. And our biggest, most expensive war, World War II, was 4.7 trillion. COVID relief costs way surpass over that. So it's a lot of money out there circulating in the market. What would this result in? So we have already seen warnings from our government and from different government bodies around the world, not just in Singapore, that inflation is coming. And there's higher cost of living. You guys would have already seen your bills. I don't know about you, I just literally opened my electricity bill and I was shocked. I'm like, why is it so high? I actually consume less, by the way, in the past few months. Okay, and this month was like quite low, but my bill was way higher than my past few months. So it was quite scary. And I need to discuss with my husband. We really need to like consume even less, okay, and make a plan, because the costs are not going down. Okay. And of course, even WP is saying that this cost of living is likely a pressure point this year. So higher electricity bills, I believe, is only the start. I won't be surprised if we next see hawkers and food vendors start raising their costs. Why? Because they also need to pay electricity, right? And when electricity bills go up, then they'll have lesser margins on their char kway teow, chicken rice, or chai fan. Okay. And as a result, like things are just going to go up. So if the problem is when you stay in cash, your $10 last time maybe your $100 can last you for 1 or 2 weeks. But this year onwards, we don't know whether that will last as much. So it's not a good idea to stay in cash, if you ask me. In fact, if you are heavy weight on cash, you may want to start thinking about how to deploy it. Even if you were to deploy in like, even you're super risk adverse and you want like very, very, very low risk stuff like fixed deposit or even like cash plus cash management options, okay, you at least want to be out of that low bank interest rate that you're getting and keep up, or if you can, beat inflation. Otherwise, the value of your dollar is just going to be less and less, and savers suffer when inflation happens. Historically, that has been proven. So what should we do? Okay, so what is happening to stocks then when the Fed raises interest rates? So they've actually gave us a what's that word? They've actually projected 3 rate hikes this year. Don't be surprised if there's more, because of course the Fed can do anything that they want. Okay, today they say 3, maybe tomorrow they say 5, who knows? Okay, but at the end of the day, as interest rates rise, right? Some of you might be wondering, why is the stock market crashing? So here's a very quick explanation. Because when it costs more to finance, okay, the cost of borrowing goes up, right? Then what happens to companies with huge debt? They now have to pay more interest on those debts. Okay. At the same time, okay, profit margins also go down because of higher cost of operations as well. Okay. Higher cost of borrowing, higher cost of operations, everything combined, profit margins tend to generally start to trend down or lesser than they were before in a low interest rate environment. And those who are heavy leverage will suffer. So for growth stocks, especially, the reason why they've been hit so badly in the past few weeks is because their future earnings are now being discounted at higher rates thanks to the hike in interest rates. So for those of you who are not familiar with discounted cash flow and how valuations are being calculated, you can go and read up about it. But in short, higher interest rates leads to higher discount rates, and therefore stock prices tend to plunge. And we're starting to see a flight to safety. Last year and the year before, everyone was into tech stocks and very speculative stocks, unprofitable companies, and they were driving it to insane maniac kind of prices. Okay, today we're starting to see a lot of them start to panic. Investors who got into very, very speculative, unprofitable growth companies are now down by 20, 30, 50%. Some may be fundamentally good companies, but because valuations were very high last year or the year before, and you entered in during then you'll also be sitting on paper losses right now. So it's very painful. And what a lot of institution and retail investors are also doing is that they're going to a flight to safety. So we've seen Apple rise in this kind of climate, and the old economy stocks are starting to come back into the limelight. Okay, and I think one of the reasons, on hindsight, one of the reasons why Apple continued rising and surpassed the 3 trillion and drop again, but they will hit it again shortly. Okay, so reason why is because Apple has a lot of cash on its books. So even if interest rates rise by a lot, companies but like Apple, who are very profitable with very good profit margins and a lot of flush cash, they won't be affected as much as another company who is not yet profitable, still investing a lot in R&D and sales and development in order to really build their business and earn more. Okay, so we're starting to see that happening. And IPOs huge last year. I think some of you who tuned into some of my previous webinars, or you're asking me online on social media, I did mention that I wasn't very keen on a lot of the IPOs that came out last year because IPOs were going out at a very, very strong market. And typically then the likelihood that you would be in losses after that is higher than if they go IPO in a not so bullish market. Okay, so I think right now you can see a lot of IPOs are down. Like, Robinhood was the darling last year, right? Look at them now. And there's a lot of others as well. Okay. And then we're starting to see a lot of investors move out of tech stocks. Okay, markets are now rotating. So for all those YouTubers who are saying growth investing is the way to go, value investing is dead, I wonder what you'll be saying this year, because now the money is starting to move back into value stocks. And I'm starting to see, worryingly, a lot of people online asking for help. So they say things like, I was a new investor, I just started investing last year, or when COVID hit, I bought a few stocks, and then they share what they were bought into. And you can see like this one anonymous investor, like, wow, I see this kind of portfolio, my heart also very pain. Like, wow, you really need like a stomach of steel to tahan this kind of drops there. 50% for like I don't know if this is the investor's entire portfolio lah, okay, but if these 6 stocks are that person's entire portfolio, to see 4 out of 6 stocks down by 50%, wow, it's very painful. And the rest, like, I don't see any profitable ones. Okay, so yeah, the portfolio allocation is very important. But if you ran in heavily onto this because you listen to, all the people who say growth investing was dead and tech stocks is the only way to go, stocks only go up, well, we need to really think about how you want to change your strategy or adapt accordingly right now. Okay, so well, I like to put this here, right, because in 1 year from now, or when early 2022 is over, then I want to go back into this and say, look, in January, okay, I had this webinar and this guy, Harry Den, you can go and Google who he is, say that the stock market is coming and, BOA warns that 20% drop. And then we'll see whether that happens. Okay, a lot of times the doomsday scenarios don't really play out, or they don't play out as badly as they expected. Okay, so the truth is, I think nobody really knows whether the stock market will crash. We're starting to see a lot of stocks correct, but the larger market, if you look at it, S&P and 500 is still up. A lot of the indexes are still performing fairly well, with the exception of Hong Kong, because of the whole China regulatory action hitting them on the whole pretty hard and being dragged down by a lot of the larger Hong Kong tech companies that is a part of their index. Okay, so I don't know. Let's see how things play out from here. But I think the most important thing to take note of is that it's incredibly hard to time the market. Okay, really, really, really hard. And having invested for many, many years now, I can really tell you that it's super, super hard. And when I manage to exit at a high, right, it's always because of luck rather than skill. Okay, you can always use, GA and charting and all of that to help you time in and out, right? But there is also the other side of the picture whereby you do that and then you go out of fundamentally good stock. You may not get in again due to different psychological biases, or you may have exited too early, so on and so forth. So there's no clear way. Okay, but the very important thing to note is that spending time invested in the markets is more important than trying to catch the high and the lows. Of course, now, like everyone else, I also wish that I had exited last year at the high. Who doesn't, right? Like on hindsight, we're all like, I had this stock, it went up here, I should have sold here, or maybe even like here, then it'd be at the peak, but near the peak, And then now the question to ask is, why didn't you? Okay, so even if we were to go back in time, right, without knowing the later part of the chart, you would have still made the same decision probably. Okay, so try not to time is really difficult. And it's, if you are seeing paper profits evaporate like I am, I think that's not as painful compared to seeing your capital go into paper losses. So regardless of where you stand right now, just really figure out how you're going to invest moving forward. And the good thing is that investing, right, like all investors who have been around or have been investing for a really long time will always tell you, it is not a race, it is a marathon. Okay, it's not like a one night affair. Yes, a lot of people made a lot of money in 2020, 2021. Newbie investors are hearing stories of people getting like 40% returns and then looking down on like very, very good investors who have been around for like 10, 20 years who were not getting, of course, 40% returns. So you use like 1 year of performance to judge the rest, right? But, I think the market rotations are now starting to happen, and it's just really incredibly hard to time. So if you were at really good returns previously and you didn't cash out, then let's think about how you want to restructure your portfolio moving forward. Okay, so what to do? Okay, so I think before we go into specifically what to do, and of course we don't know your individual financial situation, so we can't give specific advice, but we can give you some broad guidelines. You can ask any questions, the Q&A, if you want some you want our take on it. Okay, but I think the first thing to do is take a reality check. Okay, do you have any debts? If you have any high interest debt, right, please pay that off first, like your credit cards or your loan shark. I'm just kidding. I hope you didn't you didn't borrow from any loan sharks. Okay, but let's say if you were leveraged, be it in the stock market or you were using margin trading, okay, you may want to start paring down on that. Okay, and whatever that has really high interest, okay, margin financing also has very high interest, by the way. So you want to be clearing those off first, because doing this will ensure that you can survive the marathon. Okay, otherwise you will be very tempted to liquidate at really bad timing just because you need the money. Okay, the second reality check is you want to be looking at whether you have enough emergency savings parked aside. So ideally, a lot of people guide for 3 to 6 months of expenses. If you are very kiasu, you're very conservative, you can even use income. Okay, so using 3 to 6 months of income will give you a bit more buffer, because if, let's say, anything happens, you have to take time off work, that can also help you more. But of course, staying too much in cash is a problem. Okay, so if you use income, then think about parking some of that in different assets rather than purely in the bank. Okay, so that you can at least not have so much being eroded to inflation. So the third thing to note then is, after you've taken care of your high interest debts as well as your emergency savings, money that you really need or may need, okay, you want to figure out what exactly is your risk appetite. I think this risk management, and I think the folks at Syfe would agree with me, pretty much went out of the window for a lot of people in the last 2 years, because it was a bull market and everyone was making good money. Okay, really good, almost everyone. Okay, it was just super easy to make money. Almost everything you buy also go up, right? So risk management, like people are just like, unprofitable, never mind. High valuation, 300 plus PE is okay. Just go in, high can go higher. Okay, so now that we're starting to see that is no longer the case, okay, you need to figure out and really sit down and ask yourself, what is your risk appetite? Okay, are you you cannot even take losing any money, like you cannot even lose 1 cent, okay? Or you B, you're okay to lose up to 10 to 15% and you can actually stomach that drop without panicking? Or are you someone with a little bit more, your stomach's a bit stronger, you're like, 30% drop is okay because I also don't need this money and I think 30% drop doesn't really worry me at all, okay? Or are you someone who can say like, I've lived through 15% drop, this is nothing, or even 75%, okay? Or even better, if you are F, which is life goes on even if my investment goes completely to zero, then that's very good. You confirm can stay invested throughout the marathon. Just make sure you're invested in the right things, and not things that will really go to zero. But really just look at your risk appetite, because let's say, for example, if you find that your risk appetite is more of an A or B, but your portfolio is like 75% exposure to growth stocks, right? Then obviously you're not investing in a way that is sustainable for yourself. And that is just you killing yourself in the long run, because you'll be panicking. If you're someone who can say you are D or E, right, and you have a larger exposure to volatile stocks, then that's fine. But not if you have a lower, appetite for risk. So really figure out what is your risk appetite. Take a look at your portfolio, review it right now or after this webinar, okay, and see if you may want to start trimming your exposure or reallocate some to, safer investments or fundamentally stronger investments that won't be as volatile. Okay, so the next question is then, how much resources do you have? And I'm not talking about money, okay, like I think the word resources is broader when you come to the world of investment. Okay, it's also about skill. How good are you at picking stocks? And then how much time do you have to study, monitor, and even transacting? If you don't have a lot of time to act fast, right, then you probably shouldn't be trading the markets. If you don't have time to study or monitor, then maybe you just want to be like an ETF index investor. Okay, if you don't even have time to look at different ETFs, right? And ETF investing looks at lesser things than, let's say, individual stock picking. But if you don't even have that amount of time because maybe you're a busy parent with young kids, and after they come home from work, you need to start, prepping them for bedtime routine. Then you need to wake up early to send your kid to school, then go to work. You don't even have time for yourself. Then maybe picking stocks or even picking ETF teams may not work for you. Then you may want to just buy market and be happy getting market returns. So you need to figure out what are your resources, okay, and invest in the way that fits your amount of resources. The good thing is that, there are a lot more services nowadays that can help you to increase and feel bridge the gap in terms of your skills or knowledge. You can actually buy like paid reports. There are a lot of paid research companies that more tools online, both free and paid, that you can use to try and shortcut your process. But it doesn't mean that your time spent is still zero. You still need time to go through and digest all of this, right? And of course, you also need to keep up with the news, because like if you don't even know that the Fed is projecting 3 rate hikes this year, then when it happens, you'll get a very nasty surprise. So you at least want to be making sure you keep up with those. Okay. So once you have figured out these 4 steps, then my advice would be, now you're in a better position to choose what approach is more preferable. Do you think you're more of a DIY investor, or do you think you'll be better off doing like a regular shared investment plan, or even through robots, which offer a lot more options than most of your RSPs in Singapore? Or are you more, if you're someone who, let's say you say you have a lot of capital, okay, like no debts and, a lot of capital, no time, zero time, you want to let it be handled completely by the professionals. You can even park your money in hedge funds in exchange for fees. Okay, so there are many approaches. You need to choose the one that works for you. If you have very little capital, then of course, like most hedge funds won't even accept your money. So which one works for you is different. Choose the one that fits your answers to steps 1 to 4. Okay. And then after that, once you figure out what type of investor you can now start to choose your assets. Okay. So how do you want to start structuring your portfolio? You may want to think about how much you want to allocate to fixed income, bonds, or even your CPF. Like for me, I view my CPF as a very solid AAA rated Singapore government bond. So to me, that's being protected. And if anything else in my investment portfolio is very volatile, goes up and down, right, I'm always comforted by the fact that I know my CPF is on the right track, and I at least still have sufficient for retirement. And if my investments were to do really badly, right, like what's the worst thing that could happen? I would still have money for my retirement because of my CPF. So it's okay. Okay. Of course, CPF is not the only option. There are bonds and annuities and many different products out there in the financial markets that you can use. So you have to start thinking about which assets. Okay. Then the higher risk or more volatile ones in that sense would be like the equities, which can be your ETFs or stocks. So ETFs are less volatile than stocks, unless of course you pick ETFs with a lot of volatile stocks in them, and that's a different question. But at least the volatility in a basket of stocks is very different compared to just one stock. Okay, so you can think about which one suits you better. You can also you don't have to choose one, by the way. You can also have a mix of both. Okay, so I do have a mix of both stocks and ETFs. And of course, if you are someone with higher risk appetite, then maybe you might want to think like, oh, crypto is in the news nowadays. I think I also want to get some exposure to crypto as an alternative asset class. That's fine as well. So you need to then think like, then how much percentage or how much exposure are you willing to have, and you stomach. Okay, because crypto can go down by 90%. Or even 95%. And there are some crypto coins, okay, even local projects that launch their crypto coins that have gone to zero. So yeah, the odds of stocks going to zero is a lot lesser compared to crypto. So you need to take into account your risk appetite before you go all in. Okay, and then of course, if you have any other assets like property, so on and so forth, that you want to be looking at, you can also add it in. So the other thing is that, if you choose stocks or ETF, right, then you may start looking at, I think like companies like Amazon and Google are fairly safe in our new world. Even Netflix, because people are not going to stop Netflixing and chilling. Okay, so if you believe in that, then you may want to look at their shares. But if you notice the share price are pretty high, in fact, I think a little bit higher right now, because I did this slides a few days ago. So if you cannot afford that, let's say your starting capital is only $10,000 or $1,000 or $500, it can be quite hard to buy into the shares. So what you could do is you can actually explore ETFs, or you can even look at fractional shares investing as a good way. And the other thing is, remember, this is a marathon, right? So when you're in seeing your company, you all know the adage of buy low, sell high, right? But the reality is many people buy high, sell low. So if you bought high, don't sell low. Okay, what you can do is you average down. So when you average down, you're actually bringing down the cost of your initial investment. Okay, and when you average out across the number of shares, that can actually bring your cost of the investment down. And then when the stock rebounds, or when it recovers, or when the thesis plays out, when the market turns, then that's where you can then sell higher later on. Okay, so the other question also is, of course, if you're into stocks like Amazon, it's very hard to average down, because every time you average down with one share, you need to have at least 5K sink. So it's not that easy. But in this case, if you're on a platform that offers you fractional shares, like what Syfe is launching in the coming week, then that could also be another way to help. Okay, so the next thing is then you want to be working out your asset allocation that are at your desired exposure and level. So for instance, most of you would probably be adopting something like the core satellite investing, because it's the easiest way. It's also very stable. It allows you to have a very strong core while still being able to ride on rising trends and emerging trends through your satellite portfolio. Okay, so you can read about it on my blog. Just Google SG Budget Babe core satellite investing, or even on Syfe, they've written quite a few articles on what this is and how you can implement it. Okay, so if you are into this strategy, also look at what are your percentages of your satellites that you want now. What is your percentage of your core? Does that fit with your risk appetite level that you answered in question 4? Okay, so really work out your percentages, and you'll be able to better work through the market and stay invested then. Okay, so for example, if you are very, very low risk, right, then maybe, I got this example from Syfe's website. Here are 5 different ETFs, okay, with different risk level and risk score. So if let's say you are someone with not such a high propensity of risk, but you like ETF D and F, which are ranked as a higher risk score on Syfe. But what you could do is you can have a lower allocation. Can you see here in this pseudo portfolio, right? Actually, maybe it's a real portfolio, we don't know. Okay, but in this scenario, then the investor allocates less than 10% of his entire portfolio to these more volatile, more risky ETFs. Okay, so if that's something that you need to work out, go and work out as well. Or if you haven't yet scheduled your call on your existing Syfe customer, you can always speak to their team to kind of get a sense and get their thoughts about how to structure yours. Okay, and then of course you want to be looking at what teams do you want to be positioning yourself for the near future. So even though there's a lot of noise on the macro scene with rising interest rates, inflation, so on and so forth, actually if you take all of this out, right, and you ask yourself this very simple question: in the long term, are things like disruptive technology going to go away? Will healthcare innovation stop? Will the growth of China be gone tomorrow just because, CCP is now cracking down on companies? Will ESG and clean energy be gone just because they're not doing very well for investors recently? Or will we continue to innovate, and then these companies will eventually, come back up on the radar, and then, valuation starts correcting to what they really are, so on and so forth. Okay, so choose your theme. Syfe has very good thematic portfolio that you can look at. But of course, you can also create your own if you want using Syfe Custom. And then that's what I did, for example. So let's say for me, I think if you guys have read my blog, right, I actually quite like ARK's exposure. I know ARK hasn't been doing very well. Okay, it's normal. After their huge run up in post-pandemic, it was only expected that they would be correcting. Okay, so if your ARK portfolio is down, don't worry, you can average down. Okay, if you still believe that they're fundamentally still very strong. So look at the ones that you have. You can customize your own, average down, build up your own. It's up to you. Okay, and my last tip before I pass the time over to Ritesh is that if you have your bonus or whatever money that you have right now, right, I do believe that we do need to spend a little. I know my alias budget babe sounds the opposite of what I'm saying now, but not everything in life has to be a budget. I think in order for you to survive this marathon, right, survive through the years as an investor, you can't be too hard on yourself. Because if you make your investing journey very 辛苦, as the Chinese would say, very difficult, very tough. Okay, like, let's say every single cent that you have left over from spending goes towards investing. You never ever spend on yourself, even if it's a simple bar of chocolate or going to the movies, or going on a very short holiday, like on cruises, so on and so forth. If you don't spend a little bit to pamper yourself on things that you like and enjoy that make you feel good, I find that it's very hard to sustain. So for myself, for instance, some of you might know, I really love going to the movies. So I will treat myself, because that kind of declined because of the COVID situation. But I will tend to treat myself by buying a movie ticket. And sometimes I just watch movies alone, because like I don't mind. I just like the whole experience. I don't care whether anyone's watching with me, right? And to me, that's like my way of pampering myself. So I won't be so hard on myself such that I don't feel good at all. And because I do pamper myself, I know it's not very expensive, but I don't have very expensive hobbies, so that's a good thing. Okay, so whether you like cycling or watching movies like I do, or watching Netflix, whatever, spend some money to pamper yourself so that you can continue this investment journey. Okay, because it is the years that matter, not just last year, not just this year, but it's the years to come that will matter whether or not you eventually reach your desired financial freedom or your retirement goals. All right, so with that, I'll pass the time over to Ritesh. And if you guys have any questions, let us know in the Q&A. We'll be addressing that shortly. Ritesh, over to you.
Hey, Dom, thank you so much for covering. It was really a very, very comprehensive, coverage of the market, as well as like financial journey, people thinking. I mean, it's start of the year, so everyone must be like looking at their investment portfolio, looking at their finances, just, having the New Year resolutions and stuff like that. So definitely very, very helpful to think through all of these aspects as, you plan your year ahead. I really liked the one slide that you had where it showed the market's ups and downs. And it kind of sort of, encompassed all of those aspects that you were talking about, right? Yeah, exactly this one. Because I think whether there is interest rates hikes, whether the market's going to melt down, whether there is a doomsday scenario and all, what I think is more important to note is even if you invested right at the top of the market, the biggest thing to note is over time, if you remain invested rather than, trying to time your entry and exit, you would have made money, right? So I think that's the biggest lesson that all of us who are attending this webinar today should note, that don't be, like too fearful of the markets. The markets will be what they are, but essentially the key to success and the key to wealth building is to remain committed, remain invested over the longer duration. You will make money. Of course, choose your investment wisely. And that's why I think the aspects that Don covered in terms of core, satellite, like, diversification, these become very, very important as you think through how you want to get your investment process started. Because essentially, if you are very, very concentrated, there is specific risk associated. And if those, idiosyncratic and specific risks play out, you can have outsized kind of, negative experiences in terms of return. And the bigger thing is the more you lose, it's actually very, very tough to recover. I mean, there were some examples that Don, you shared about like stocks going down 50%. Just bear in mind, if you invest, say, $100 and it goes down to 50, the loss is 50%, but the recovery that you need is 100%, right? Very, very important to note, right? Like it's very tough to go back once you have lost that much amount. So the only free lunch in the market is to remain diversified, right? So if you diversify your holdings, the specific risks that are, potentially there in the market, for example, Baba, I mean, like it's such a great company. It's, got such huge revenues and all, but just because there is a specific China regulatory risk associated, it's down 50%, right? So it can happen not just to like non-revenue generating, like, or very low revenue generating companies or non-profitable companies, but even for very profitable companies, there are specific risks associated. So always look to diversify first, have a more, kind of global diversified kind of growth portfolio to begin with. And then, if you have the appetite to express yourself, do it through your sort of satellite allocations and all. So that would be my, like, kind of add on, Don, on top of what you covered. All right, cool. So maybe just let's take a few questions. I think we are already 40 minutes into the webinar. So Joshua, if there are a few questions, let's just take them and then we will move forward.
Yeah, sounds good. Thanks, Don, for sharing so much tips with us. I think that's a lot of good advice over there. I resonated particularly with the ending tip lah. So just kidding. So right now, right, we have a couple of questions coming in. So the first one is actually, with regards to the debt that you covered in the earlier part of your session, right? So a viewer is actually asking whether or not would you advise, someone to pay off their housing debt first before investing the money? Can you hear me?
Yes. Sorry, I'm just looking for the question again on the chat. By Li Ying, right?
Yeah, correct.
Yeah. Okay, so I feel it really depends on your housing debt and what you want. Because for some people, they may sleep better at night if they have a fully paid house. But if you ask me financially, I don't think that makes sense at all, because if you look at the bank interest rate, I don't know what percentage this person is on for their bank loan, or maybe HPB loan. Okay, but my rates are pretty low. I think it's like 1 point something. So to me, it's very easy to get more than 1 point something% elsewhere. Like putting the money in CPF, for instance, is a no-brainer approach. Right, of course, because the lockup lah, so there are always trade-offs, okay? Or even investing in an index fund, investing in thematic ETF, so on and so forth. So because of that, right, I don't rush off to pay off my housing debt. Yeah, in fact, I don't know if how many of you have actually read my recent blog article. Several years ago, I talked about how I will not be using my CPF to pay for my house, and it went viral because everyone's like, "What? But I use my CPF. You should use CPF, so zero cash upfront, And then I was like, "No, I believe more in using cash to pay because my CPF can grow at a certain rate. So why use my CPF?" But of course, when I got my house, that was the start of the COVID lockdown. And at that point, it's like, wow, the market crashed so much that it was a no-brainer. To me, I got very excited because it was very obvious that this was time to go in. So we actually made the decision, my husband and I, to use my CPF first to pay off the monthly mortgage so that we had more cash to invest in the markets. And of course, it turned out to be the right call. But moving forward, like, we don't know, right? So to Li, what I would say is, if you feel very uneasy about your housing debt, then you can always, and you believe that interest rates on your mortgage will rise to the level whereby you are going to have trouble paying that higher rates, then you can always think about whether you want to pay that off. But for the majority of people, I don't think you need to pay off your housing debt before investing at all. Because property investment and leverage, using that housing loans are completely different ballgame, right? And why would you want to pay off completely when the rates are relatively low? Yeah, so I don't count that as a high interest rate. To me, high interest debt are things like credit cards and margin financing, because credit card debts are more than 25%. That's a lot compared to your housing debt, which is like 1 point something, 2.6%. It's nothing. Yeah.
Right, thanks for that. Okay, so on that note, right, on the contrary, if let's say, client today has excess money, would you actually recommend the client to top up into their CPF SA or invest?
Oh, that's a good question. So again, I think it depends on what the client wants, right? Like, if you believe, right? So I go back to my slide whereby I had the allocation one, this one. Okay, so if you want more exposure to like lower risk, more guaranteed kind of financial instruments, then of course that would be your CPF SA, right? Because it's 4%. It's a no-brainer. But if you think that you can actually get more than 4% by yourself, then you might want to go for investment. If you're not sure, then why not do both? So for me, I do both. I top up my CPF SA to the max that I can for tax release purposes. Okay, I've been doing that ever since I started work. But at the same time, I also invest a lot. So I employ both, because the thing is that the way I see it is that 4% is guaranteed. So it'd be foolish for me not to take it. And on the other hand, for investing, there are certain years that are very good, and there will be years where it is bad, it's difficult, and it looks like 2022 is starting to shape up to be like that. We don't know, but at least the past few days have shown us that might be the new tune moving forward. But because it's so hard to time, right? Like, who would be able to sell high and buy low all the time? It's very difficult. So I do cover both, which is why I said my CPF is really, really a strong base, so that if the worst case scenario happens, okay, which I don't think it will, but if everything in my top portfolio goes to zero, I'm okay because my CPF SA will still cover me.
Right, right. So, what would actually, be the top sectors that you are looking at for the year of 2022?
Let's just hear what Ritesh and you guys at Syfe also think about it first.
Yeah, maybe this question Ritesh should take it.
Right. So see, I think of course, as a whole, as I mentioned, look for a more diversified exposure into the markets. But if you look at just macro and how different sectors behave depending on different sort of economic cycles and all, what you would observe is when there is interest rates hikes and generally there is inflation, then there will be certain sectors which will tend to do a little bit better than certain other sectors. So I think part of it was covered by Don when it is talk about value versus growth. Typically, the growth stocks tend to get more impacted when the interest rates are on the rise because their valuations are based on future growth. And future growth, when you discount it and the discount factor increases, then naturally the present value of these go down. So from that perspective, the more high growth sectors and all tend to be kind of negatively impacted when the interest rates are rising. At the same time, I mean, don't get me wrong, not saying that growth investing, kind of is dead and you only should do value. But the point is that is kind of a natural phenomena. Over a more longer duration though, I think if you're looking at growth as a sector, it will continue to kind of have an outsized influence in our lives going forward. So if you're looking from a long-term standpoint, you shouldn't be worried too much about it. Other sectors which tend to kind of benefit with rising interest rates tend to be commodities, energy, inflation related, sort of sectors, as well as interest rate sensitives, right? Financials, for example, bankings. If you just look at last few days as well, the banking related or financial sectors has been kind of outperforming the more sort of growth sectors and all. So typically I would say those are the ways that you would look at. Even for example, real estate and REITs, if there is inflation, but alongside inflation, there is basically growth attached to it. In a growth inflation kind of a state, REITs or real estate market tend to do okay. So those would be a few things to think about.
I think for me, so yours is more very broad, right? I don't know if this person is trying to get more specific stuff as well, but I'll give my take. I think these teams are not going to win. Yeah, so I just don't know whether they'll do well in 2022. You see, so I think what we're starting to see is money flowing into more old economy stocks, safer stocks, cash rich, or low debt, already profitable kind of companies, whereby the cash flows and the earnings are clearer rather than very growth have their earnings built to turn profitable later on. When it will run, because I'll use Tesla as an example, right? We all knew that electric vehicles were a trend moving forward. Everyone, most people of us, who have also already heard of Tesla, but most people did not invest in Tesla. Why? Because we had no way of knowing when Tesla would run. And was it luck or probably multiple reasons, and also Elon Musk clout that drove Tesla stocks to sky high prices last year, in 2020, okay, when the pandemic first started hitting in. So we wouldn't know. Tesla, if I remember right, when Tesla first started hitting crazy valuations that year, it hadn't yet turned profitable. Because I know I was looking at it and then I was like, I'm tempted, but I just cannot, justify it yet. So yeah, I'm not invested in Tesla. Do I regret it? Of course. Okay. But if you were to throw me back the same scenario, I still would have invested because it is very high valuation. As someone who places a lot of weightage on evaluations, right? Maybe it is the fact that I don't know enough about Tesla to make a better judgment of their future earnings, or it's just that I'm just very uncomfortable with the valuation that they are hovering at. But at that point when I studied it, I still felt like it was way too high. And then, it just continued going higher and higher and higher and higher. And then it corrected, right? Temporarily, then it continued rising again now. So how's the time? It's really, really hard. But I think if you ask me, right, will disruptive technology, healthcare for the aging population, China growth, ESG, and all this be running in the years to come? The answer to me is a definite yes. But which year? I don't know. Would that be in 2022? I don't know. Because who knows, right? Like GameStop also ran in 2020. Who would have expected that? So who have expected meme stocks to go so high in 2020? Would they replicate again this year? We also don't know. So rather than trying to guess each year, I always just focus on the long term. Yeah, but Jashan, you also speak to a lot of clients. What do you think will run this year? Do you have any guesses?
Right. I have no doubt that like the fundamentals for these teams remain intact, right? And I do really think that, at some point of time, all these teams will actually play out. How I actually recommend my clients to approach, this investing into such a thematic portfolio would definitely via dollar cost average, right? Because putting in a huge lump sum, of course, you risk that, maybe your funds might have a huge loss. But if let's say, you go in via like a dollar cost average, you kind of enter regardless of market situation, that can also help to release some of our anxiety also, right? So I think with that, let's take a pause on the Q&A. So I think Ritesh should have a bit more slides. So let's cover that, before we come back to a Q&A session again.
Okay, let me stop sharing.
All right, yeah, so just give me a moment. So I thought what I will do is quickly wrap it up with a little bit of an introduction to Syfe as well, and potentially how you could, use our platform for your investment needs as well. So Syfe, we are an MAS licensed Singapore headquartered company. We are a digital investment platform, which is basically building the next generation of financial solutions for individuals across Asia. We have, as I said earlier, a fund management license. This is what is called CMS, Capital Market Services License. It tends to be the gold standard when it comes to managing of money. And as part of this license, there are safeguards built into the process of how your money is managed and how secure and safe your funds are kept as well. So as part of the license, there are very strict requirements that we need to adhere to. Part of it is basically all the client assets are kept completely separate from our own assets. So what that ensures is, even in a worst case scenario, something happens to Syfe as a company, all client assets, they're held in custody with the likes of, we use Saxo as a sort of broker, and then the custody of assets remains with banks such as Citibank and HSBC. Similarly, when you transfer money to us, it actually goes to a trust account, which is held with DBS. And again, we cannot commingle our own corporate money with client money, and that ensures that essentially all your money is kept safeguarded and you will be able to redeem them in full. Doesn't matter whether Syfe exists or not. But we are here to stay, right? We are not here to we are not here to just try it out, right? We are very strategic in terms of what we are building, and our goal and vision is to democratize investments for the broader Asian markets. And it's been a great ride for us so far. We launched in 2019, and since then we have grown from strength to strength to the extent that essentially we are one of the leading personal finance apps in Singapore. We won the best digital advisory solution by Ditchfin last year. We also won a couple more awards last year, where our CEO and founder, Dhruv Arora, was recognized as the top 10 FinTech person of the year, as well as Samantha Horton, who is our VP for business development, who was recognized as the top 3 women in FinTech in this part of the world as well. Our assets grew massively, partly catalyzed by the fact that the pandemic led everyone to kind of stay at home and look at their finances, and the adoption of the digital wealth management platforms really skyrocketed. And we were lucky to be part of this journey as well. On top of that, we've got very strategic backers, and till date, we've raised more than $52 million US. What that means is we are continuously innovating, we are continuously investing into our platform to make the experience better and better, and build more innovative solutions to our users such that they can get more personalized investments as they move along. Just kind of bringing back aspects that Don had shared in terms of core satellite investment strategy. Of course, you can go with a more active approach to investing where you DIY, and the intent there is to kind of outperform the market. And potentially there could be higher cost if you're leveraging the skill set of an active fund manager on that regard. The other approach is you go with a more passive approach. You basically believe that markets are very hard to beat, and you would much rather lower your cost because that is under your control. And that way of investing is called passive because you invest into the broad-based market indices, and that can be done via instruments such as ETFs, which are very, very efficient for you to get broad level market access. And the reason I think, like, when you think about active versus passive, there's always that debate, like which way and what should be done. Research has sent, again, like, beyond just the time commitment that you have to do on active side, almost 90% of active managers tend to underperform the benchmark. So how do you justify the amount of fees that you're paying there? And if you just look at the bottom half of the slide, what you would realize is that most of the long-term returns are actually dominated by how asset allocation, how your overarching portfolio is constructed, rather than how individual security selection or the market timing aspect of which only contributes to roughly around 6%. So what is much more important is, are you creating a much more robust kind of a portfolio that can go through the ups and downs of the market? Or would you just like, construct something which gives you the highs of the market and you feel very good, but there could be downturns and it will be very hard for you to recover. So that's where I think the core satellite approach can help you make sure that you have a solid foundation to begin with. And what that means is invest the bulk of your investments through an index-based solution in a more diversified manner to cater to your long-term goals. And that way is, even if there are corrections and all, you will be able to weather through them in a much more effective manner. And then as an investor, all of us want to express ourselves and we want to personalize our investments. And that's where a satellite and active approach can be put as a layer on top of your core. And that's where you can put a smaller portion of your overall, say, net worth or investable assets into things where you take a more active approach to outperform the market. In terms of how to go about creating a core, right? Like a rule of thumb that you can take is typically you need to think about, what level of risk are you comfortable? What is your duration of investment? And typically the longer the duration that you have in terms of remaining invested into the market, the more risk you are able to take. A rule of thumb could be 110 minus your age, which is like a very, very simplified version of how you can think about allocation between equity and bond. And what that means is if you're a 30-year-old, potentially, and again, like, don't take this as this is the way to go, but this can be like a guidance to begin with. So basically it means that if you're 30-year-old, you can have 80% of your investments into equity and 20% into bonds, assuming that you're investing for your long-term, say, retirement and related needs and things like that. And then when it comes to satellites, the idea really is to take exposure to certain themes, certain mega trends, or you just want to express yourself because you believe in certain individual countries, sectors, or individual stocks. And that's how you can express yourself through, again, you can use ETFs to do that. You can use active funds to do that. You can choose individual stocks. There are alternative solutions. There are multiple different ways to kind of express these aspects as well. But again, the point is first build a solid core and then you can go into your satellites. Now, coming to Syfe, how do we actually go about making this process a little bit smoother for you, right? Because at the end of the day, we recognize that everyone is unique and they want to build both their core as well as their satellite solutions within, and they want to consolidate everything in one place, right? So to enable that, what we offer is a core range of portfolios where the intent is to maximize your long-term returns. And this is basically a combination of your equity, bond, and gold. And there are 4 options available. So a defensive portfolio, balanced, growth, equity 100. And the difference between them is different levels of equity allocation within these individual portfolios. And again, depending on what your goals are and how long they are and what kind of risk appetite you have, you can go back to what we discussed in the core and think through what kind of portfolio is something that resonates with those goals and those investment horizons. Once you have created your core, then you are thinking about some specific things that you want to incorporate into your portfolio. That's where you want to have some satellite strategies, and that becomes like a smaller portion to begin with. And as Joshua said, maybe you want to dollar cost into some of these aspects. So if you're interested in following some of the biggest mega trends shaping the future, these are things like ESG and clean energy, healthcare innovation, disruptive tech, China growth, and related sectors. And again, a lot of the investors that we talk to and talk with, they tend to want to get these exposures, but they just don't know how to go about it in an effective manner. And that's why these solutions we have created such that you can just click and invest and get it, get these exposures without spending an enormous amount of time and all. REITs is a very, very popular strategy in Singapore for Singaporeans, especially in this low interest rate environment. People love the idea of generating a sustainable kind of passive income. Plus the fact that REITs are listed on the stock exchange over time, they do grow in value as well. So you can think of REITs as a way for you to generate passive income plus generate a growth. So this is how potentially you can create a core satellite investment strategy using the Syfe suite of portfolios. We have gone a level beyond that as well, where we created the custom portfolios, where whether you want to create a core portfolio by scratch by yourself, and this actually is a more kind of a sophisticated way to go about it, where you say that these solutions are great, but I am someone who knows what I want, and I want a portfolio builder that can give me the flexibility to design my own portfolio. Then you can use the custom portfolio because we've chosen some of the best in class ETFs for you to go about constructing either your core portfolios or your satellite investments as well. On top of that, interest rates are really low. And what that means is our cash management solution is available for you to invest your spare cash and earn a certain yield before you can think about what you want to deploy them in the future as well. We had a few case studies. I mean, I'm conscious that we are short of time, so maybe we will not be able to cover them in detail, but essentially we'll just cover maybe one of them to showcase that if you are like an young investor just getting started, I think one of the key goals that people tend to think about is like, when can I get my first $1 million? And while it might look a little overwhelming to begin with in terms of, $1 million seems so far away and, I've just started working, how do I even think of it? But what you will realize is just the discipline of investing on a regular basis. And because as a young investor, your time horizon is much, much longer, it is not that difficult for you to, build it up over time. This client also, as a case study, has some unique preferences. So they, he likes to invest into companies that make a positive impact on society and the planet. So this is a personal preference. So given this as a particular, profile of client, how can he go about designing a portfolio and investing in a straightforward manner using Syfe portfolios, right? So this is one way to go about it. And again, like this is just an example. Different people can approach in different manners. But the point is, you don't need a big lump sum to begin with. You can even start with as small as $500 a month. And because time is by your side, the compounding effect really can help you to generate your wealth or grow your wealth over time. And as a core satellite framework, what this person can think about is, because his risk appetite is high and he's got a very long-term horizon, as a core, this person is choosing Equity 100 as a core portfolio, because Equity 100, even though it's pure equity, it's a globally diversified equity portfolio. So very, very, kind of blue chip in nature and large cap and good stocks. Some of the best companies are represented here. And then because this person cares about investing in a sustainable manner, he might want to take some exposure into ESG and clean energy, right? So those are the ways that he sort of creates his own strategy and gets started. And if you think about like the forecasts ahead, and these are again probabilities of whether he can achieve or not, there is a conservative, median, and optimistic scenario. But the point is, even in a very conservative scenario, the person is generating quite decent amount of money after investing on a regular basis. We'll skip this one, and it's very easy to kind of get started with our platform, very easy to onboard. Everything is online, digital. Even before you get started, you can look at all our portfolios, you can see all the details, you can see the forecasts. And once you are ready, you can onboard yourself using MyInfo, and it's literally a 3-minute process for you to onboard, right? And once you invest, essentially, we are very, very transparent in terms of showing you all the data regarding your investments, how they're doing, what transactions are happening, what fees are you paying, all those information are available at your fingertips. In terms of fees, very, very straightforward. There is no minimum, right? Like you can start with any amount that you're comfortable with. Of course, as you invest more with us, your overall fees that you pay keeps coming down. So it can go down as much as 0.35% if you invest more than $500,000. But again, as a young investor, if you are just looking to dollar cost average and start small, 0.65% is still very, very low compared to a lot of like traditional investment vehicles, which tend to be like 2-3% for you to get invested. Cool. I will take a pause here before we move forward. Maybe 1 or 2 more questions. I think we are way out of time. So Yashwin, maybe 1 or 2 more.
Yeah, definitely. So I think maybe, just one question for Ritesh, because we have a couple of, viewers asking the same question. So what do you think sets Syfe apart, and how should a newbie go about evaluating such platforms?
Yeah, I think that's a great question. See, I think the first and foremost is the fact that, we are providing you a platform where we take the load of investing and thinking on your behalf on our side, right? And what that means is we do all the heavy lifting, right? When it comes to the portfolios, the management of the portfolios, the rebalancing, the, point about how these portfolios evolve over time, all of that is managed for you, and you're paying a very, very small cost for it, right? So that's, a default benefit that you're getting by investing into a platform such as ours. I did not cover the features and all, but essentially there is no entry cost, there is no exit cost, there is no, rebalancing fee, dividends are automatically reinvested. So the whole efficiency that this process brings onto the table is something that people value a lot. And a lot of us are very, very busy with our work, right? So I would rather concentrate my time to my family and leave these parts to be done by an expert. And at the cost of a 0.4, 0.5%, I think it is highly worth it, right? So that's number one. Number two, we have a very dedicated advisory team as well. A lot of people, again, while they want to get started, they are kind of overwhelmed with a lot of information and how do they kickstart their journey. So do leverage our team, because, Jashwin and others who form the, core of the advisory team often encounters a lot of starting investors, and the education process of how to kickstart your investment journey often can itself be a huge sort of ramp up to how your wealth can grow. And I think the last bit where I want to emphasize is just the product innovation and the way we think about you. We're always client first, right? And that's why we are making the journey of investing as simple, as straightforward to you, as well as we are making it as personalized as possible for you as well, right? And that's why if you look at our product suite, we have been constantly talking and receiving feedback and understanding what are your core needs, right? If you think about from a core need standpoint, all our portfolios try to address a need, right? When it is cash management, you're trying to get a better yield on your spare cash. When it is your core portfolios, you're trying to solve long-term growth and wealth accumulation requirements. When you have a REITs portfolio, you're trying to solve your income needs. When you have these thematic portfolios, you want to express yourself and get exposure to some of the biggest mega trends shaping the future. So again, we have tried to make sure that the platform is built in a way such that it can cater to varying needs of the clients. So if you are a very newbie investor, you just want to get started, just start with the core portfolios. If you are a more sophisticated, you want to express yourself, you can even go to the extent of choosing your own ETFs and constructing your own portfolio. So I think that is one aspect that really differentiates us. And this kind of innovation that we have brought into the table has kind of started to redefine how wealth management should be done in the first place.
Okay, thanks, Ritesh. So I think due to time constraint, we'll take in last 2 questions. Okay, and these are directed to Don. Okay, so earlier on you mentioned passive income, right? So besides REITs, could you actually share with our viewers what are some of the other investment vehicles that they can be looking at to generate this passive income?
I think REITs for dividends is one of the easiest ways. But if you want through others, right? Okay, so like in the past, for example, if you were in the NTUC co-op, you would get dividends from their shares from like having a portion of their ownership. But I saw the latest news, they're also going to change to a company, so don't know what that's going to look like anymore. You can also build up like a business service whereby you can have passive income, right? But your question that you need to answer for yourself is then, what is the value-added service that you're providing to other people. So like for instance, one of my friends runs a coaching business. So for her, right, for the community to even be in her Facebook group still, you need to pay a fee. And that's passive income for her. But if you look at it the other way, she does a bit of moderation. So is it really passive income? Not really. So there's no easy, there's no free lunch lah, basically. But if you want free lunch, then I think REITs are a very good way where you don't have to do anything aside from just investing in them and monitoring and researching them. But otherwise, if you want through other methods of passive income, I think another popular one in Singapore is also like rental. Yeah, but do you have the ability to buy a property and then rent? And rental, I can argue also is not fully passively. You still need to manage the tenant, right? If you get a nightmare tenant, then is it really passive? You'll be thinking, I only rent out my room for, let's say, $600 a month. But this tenant, every day play loud music, disrupt my sleep, then very rude, shows me black face when come back from work. I don't think worth $600. So, it's like, there's no real passive. REITs are probably the most passive you'll get really.
Right, thanks for that. Okay, so maybe the last question that we'll take in for the night. So how much do you think it's a safe amount for one to keep in their CPF account before they actually start investing using their CPF funds?
Actually, whenever people say they want to invest their CPF funds, right, the question I'll ask them back is, do you think you can beat CPF returns? Full stop. Because if you're not confident that you can beat the 2.5 or 4%, right, then why would you want to touch and risk that? Because there's also, the news articles that have been saying many people who invest in their CPF, they actually lose money. Okay, so if you invest through your insurance agent, that can also be one approach. Or you can also invest through some robo-advisors, or I think SRS also is another option where you can go direct into unit trust or certain different instruments, right? But if you don't think that you're better than the rate that CPF is giving you, then don't touch law. As to how much minimum you need to have, I think don't have like how much is enough for you. Maybe some people want to use their house as a estimate, so they want to calculate to have enough in their OA to pay off for their mortgage. Some people want to have like FRS, the full retirement sum. Some people just think like, basic retirement sum for now good enough, I can invest the difference. Some people just want to invest it because they feel that they want to try, and then they don't have enough liquid cash on their end. So their so-called liquid cash is in CPF, but it's not liquid. So this is a way of investing what they wouldn't otherwise have been able to touch. So there's no right answer. Yeah, I think the biggest question to ask yourself first is, are you confident of beating CPF returns? If you're not, then why not just use cash? Why touch your CPF?
Right. Thanks, Dawn, for that. I think, that's a very, very accurate answer, right? So I think with that, we have come to the end of today's session. And I really hope that this was an insightful session for all of our viewers. So with that, thank you, Dawn and Ritesh, for the sharing, and to the rest of our viewers for joining us this evening. And have a very restful evening, everyone.
Right.
Thanks, everyone.
Guys. Have
Thanks,
a great
Dawn.
New Year and invest safely. Let's all get through 2022 together.
Right. Happy New Year, everyone.
Happy New Year.
Bye.
Thank you. Bye-bye.